logic is, the theory is not going to be any different. The theory will be exactly the same, except obviously you'll be using different tickers and things like that. Okay, here let me try and okay, let's try and launch this. So once again, I'm showing you I'll be showing you the demonstration with respect to the crude oil options, because that is what is trading right now. Okay, or we could try gold options. Maybe this is a little bit better. Let's try gold options. So I right click on that, go to trading tools. There are other ways to do this. You can just look at the videos and do them. Look at the educational videos regarding the TWS. What happened? It's taking a long time to load. Okay, so everyone is familiar with this view by now. You have the chain view. You saw what I did. I went to, because obviously now if I do SPY or Tesla or something, because US equity markets are not open, so I will not get live prices. But the gold, just GCs for gold futures, they're traded on the this used to be COMEX Gold. Now they've merged it into NYMEX. All of this is part of the CME group, which is one of the largest futures and option exchanges in the world. So GC is the code for gold. This is the international gold market, futures on gold, traded in terms of dollars per troy ounce. So this means $1288 per troy ounce. So I just right clicked on it and launched the option trader. Okay, this is trading on the Globex platform of CME. It's trading pretty much 24 hours. The gold is that kind of market. Okay, so we'll come back to this. Now I'll just briefly give you the decision problems that you have. Okay, so let's just quickly go through. We'll get back to your notes, but where's your calc file? What's this? Okay, so I've given you this framework once again. So if you remember that these are some of the, I've given you this framework here, okay, which is the I-vol versus the bullish versus the underlying asset views. Okay, let's just try to form, I'll just write it down briefly here. Okay, you quickly go through the decision problems. Okay, so when we are looking at option trading. So you have, let's list out the specific decision problems for option trading. I'll just try to do it here. It's not going to be pretty, but we'll do it here so that I can get it all in one view. Okay, so the first decision problem when you're trading options, the first decision problem is asset class, okay, which is common to the other problems. All right, you have asset class, and then you have market, and the instrument is obviously decided because it's option trading. So it is options is the instrument. Okay, so you're trading in options, so you can focus first you look at asset class. So these are specific to option trading. We are going to just recap it once again. So now I'm redoing the whole list, option trading decision problems. Okay, let me make this a little bit smaller so that I can fit everything into one. Are you guys following what I'm doing here? Okay, we are once again trying to look at the decision problems in option trading. And so the first one is, let's go over here. Okay, so the first one obviously is, let's say, asset class. Whose phone is ringing?
No.
When you put the phones here, I presume you you're supposed to put it on silent. Okay, so the first decision problem is asset class. Okay, the first one is asset class. The second is, what is the next one? Suppose I've decided asset class, I've decided to go into equities. Okay, so when I'm trading, yeah, so next one is market. If I've decided to go into equities, next one is market. And market you can think of in two steps. So the first market, so the next one is market. Okay, and market you can think of in two steps, which is country and ticker. Okay, now we are getting down into country plus. So we are assuming that the asset class decision we have decided to choose equities. Okay, there are many asset classes, as you know. Okay, so we've chosen equities. And then the next decision is market, which is basically split into country plus ticker, okay, which you could just, I'm just making it very clear here, but otherwise if you just choose the ticker, depending on the ticker, it will automatically imply the country. So for instance, what I mean by country and ticker is, you can have certain stocks are traded in multiple countries, okay. So the Infosys, for instance, if you are trading Infosys, you could trade the stock listed in India, okay, or you could also trade the ADR listed in the US. All right, so that's why I'm just trying to be a little bit more systematic and say that, okay, market can be actually split up into country, and you decide which country you're going to trade in, and then the ticker, okay. But if you just specify the ticker, it will automatically imply the country, because for instance, if you write Oracle here in the ticker, if you write Oracle, this will automatically imply that it is in the US, okay. So you can see here, this is yeah, it is in the US. So Oracle is not going to be, even if they have a listing on the London Stock Exchange, that will not have the ticker ORCL. It will have some other ticker. So what happened here? Okay, this is too big actually. The view is too big. Still can't see most of the options. This is going to cause problems if it's so. Okay, here. Yeah, so this is actually Oracle, so we can make this a little bit bigger. All right, so coming back to our decision problems. Okay, the first is asset class, second is market. Instrument is not a decision problem in option trading because you have already chosen options as the instrument. Are you following?
Yes, sir.
Okay, instrument is not a decision problem because it's already been chosen. Okay, so then asset class, market, instrument. Then the next question obviously is to buy or to sell. Okay, now to buy or to sell, if you we'll go with this framework because it fits with the general framework. Buy or sell, fine, you take a decision on buy or sell. And how will you decide that? Okay, let's put a little thing here that it is based on eyeball. Okay, so we'll go back to the framework now. Then obviously this is not looking good. Let me just move this. It is making the framework very ugly. All right, let's put that down here and let's go back to the framework. Okay, so understand one thing, eyeball. Let's look at any of the eyeball charts. Okay, this is a VIX. Have you guys heard of the VIX? In India also we have a VIX. Now they have trademarked this name. So these guys, whoever owns this, I think S&P or somebody who owns this trademark. So this index is a trademark. It's like an intellectual property kind of thing. So it's a trademark, and this they have trademark. They have licensed the trademark to India as well. So VIX is a trademark for an index of implied volatilities. Okay. So the VIX, this particular ticker refers to the options on the S&P 500 index. Okay, so if you go back here and make it SPY, SPY is actually, strictly speaking, would be GSPC, but which is the index, and by SPY is a ticker, and if you which tracks the index. Okay, so SPY, if you use SPY and let's change this to all right, so you follow this. SPY is just 1/10 of the S&P 500 index. It is a ETF that tracks the index. This is one of your tickers. Are you guys following?
Yes, sir.
Okay, it's one of your tickers. How is it related to the S&P 500 index? You'll see it's 1/10 of the index, the value of the index. Okay, so it is safe to use the SPY to track the S&P 500 index. And what the VIX does is, the VIX is a ticker. Okay, which is, this is an index of implied volatilities, eyeballs on S&P 500 index options. Okay, so this is basically the corresponding. Now that you're trading options, you have to look at both the underlying and the eyeball. Okay, so this is your underlying chart for the SPY. Okay, and this is your corresponding eyeball chart. Okay, so what the eyeball is showing you, as I've told you in that earlier video as well. So remember, we are at this point, we have to take this decision about buy or to sell options. Okay, at this stage in option trading. Should I buy options or should I sell options? So with that, we are going to take that decision based on our view on the I vol. Okay, why do we do that? Because the I vol is the index of option prices. If you want to know whether option prices are getting cheaper in general, both equity, both calls and puts. Okay, if you want to know if option prices are getting cheaper, if that's happening, if the I vol chart is coming down, that means option prices in general are getting cheaper. Okay, so look at the I vol chart as nothing but a chart of option prices. When it's going up means option prices are becoming more expensive, and when it's going down, the reverse. Okay, so therefore what you have to do, because remember this is your decision problem, whether I should be buying or selling options, to form that. And remember, you're already locked in. When you come to any subsequent decision problem, we already assume that there is a solution to the previous decision problem. Okay, so in the case of the market country ticker, let's say I'm going to work this example with respect to the SPY. Okay, so this is our SPY, and I know that the SPY, the corresponding I vol index for SPY is the carat VIX. Okay, this is the ticker. So now I look at this, I have to form the decision of whether to buy or sell SPY options. I'm going to form that by taking a view on the I vol. This is clear. Remember, everything you do in finance pretty much involves taking a view on the market. Okay, and there is no guarantee as to what will happen. So you need to evolve a structured method for managing risk, which is why you notice if you talk to people, like if you see interviews of people like Lloyd Blankfein, who come from a trading background, okay, former CEO of Goldman Sachs, he will tell you that I'm not so focused on forecasting, but rather on managing risk, because it is full of errors, and the question is, how are you going to manage the risk? There is no guarantee on what will happen.
Sir, I was this for a particular underlying asset.
Yeah, so you have to hit the right ticker, okay? Which means, see, for instance, yes, I mean, I'm not sure exactly what your question means, but I vol index, any I vol index, okay, any I vol chart will show you how prices on options for that underlying asset have been moving.
Yes.
Okay,
So what is
so
the underlying asset in this?
in this case, strictly speaking, the underlying asset is the S&P 500 index, but we are using the SPY ETF to track the index because it's 1/10 of the index. Okay, so as far as forming, because the VIX has a lot of data, this carat VIX ticker has a lot of data. So since it is the same underlying asset, it is just 1/10. So it is just a linear, transformation. So therefore, we can just use the VIX charts to form a view on which way the I vol is going to go for SPY options also. Is this clear to everyone?
Yes.
Okay. So how am I going to decide whether to buy or to sell options? Obviously, if I think option prices are going to go up, then I'll be buying. If I think option prices are going to go down, I'm going to be selling. And how will I form that view on option prices? I will do that by looking at the I vol charts. Okay, so I need to know the ticker. Obviously, this is where your contextual knowledge comes in. If you're trading Oracle options, you will have to figure out how to generate an I vol chart for Oracle options. Okay, then you are not going to form a view on Oracle options by looking at the VIX chart. That would be a very poor proxy. Okay, all right. So now, is this clear now? I have to form a view on this. Okay, so let's say I decide that I look at this chart and I decide that, let's say I'm a mean reversion person and I feel that, of course you can make this little bigger as well. I mean, you can get a lot more data, and usually, and you can see, notice one thing about the I vol charts, you see how odd they look. You've seen lots of other charts of euros, euro dollar Swiss, this, that, copper prices. You notice how odd they look, the I vol charts. They're not like normal stock. They are kind of like they squiggle around for a while, then there's a big jump, and then they drop. The behavior of I vol is very different from the behavior of any underlying asset. Okay, these kind of things you should develop a feel for. So you can look at this long-term data on I vol charts. Okay, now, so let's say I form a view that I vol, I'm a mean reversion type of guy, and I feel that I vol prices are going to go, I vol chart, the chart is going to go up, it's going to shoot up, which means option prices are going to rise. Okay, so now I've already solved this problem, the problem of buy sell. I'm going to be a buyer. This is clear? Okay, I'm going to be a buyer of options. Okay, now what else is, so if I'm a buyer of options, is there any other decision problem left?
Sir, call or put.
Call or put has to be decided. Okay, I can fine tune my market play by, I can fine tune my speculation by deciding whether to buy calls or puts. because that will get the impact will be very different depending on how the underlying asset moves, right? Depending on how the underlying asset moves, if I can of course buy both calls and puts, that's also an option, okay? But is there a smarter option? A smarter option, because calls and puts will not behave the same way depending on how the underlying asset moves. Okay, here's your SPY chart. Okay, you can see this if you form a, let's say, I think hopefully, yeah, it is still there. Okay, so here's your SPY 5-year data on the SPY index, okay, on the SPY ETF. This is the US stock market essentially, the broad index. So depending now, if I buy both calls and puts, that's one kind of option, okay? You can't do that. But there are certain strategies like straddle, long straddles, long strangles. If you read your CME options book, remember in your finance reference, there's a bunch of books in your finance reference folder.
Yes.
From the previous course.
Yes.
There's a bunch of books. There's a book by Sheldon Nattenberg, okay, on option trading, okay, option trading and I think volatility strategies. I don't remember the name of the book. But then there's also the 25 CME option strategies. You can check that up, okay? So there you'll find lots of strategies like straddles, strangles, butterflies, condors and all that. But before you get into all that, you should have your basics clear. There are many option strategies, but your basics should be clear. So the point I'm trying to make is that obviously if you're bullish on eyeball, you can just buy options. You can buy both calls and puts. But can you be a little bit smarter? Like if you can also take a view on which way the SPY is going to go, the underlying asset. Remember, this is the underlying asset now, okay? If you can also take a view on which way the market is going to go here, suppose the market is just going to keep shooting up, okay? In that case, would you have been, what will happen to your puts if you buy puts and then the market shoots up?
So decrease.
The puts will lose value, right? Put is a right to sell. Everyone is not clear even about this. Just make sure at least you understand this part. Every step, the logic should be clear. Everyone knows that a put is a right to sell.
Yes.
Okay, so if you buy both calls and puts and then the market from here keeps just shooting up, okay, goes to new highs, then what will happen to the puts
Decrease.
that you bought here? The puts will lose value. Okay, let's say you buy at the money puts, which means you buy the puts at this, whatever this price is. I can't even read it here. It's 279, okay, because of the reflection. Okay, so the price is 279, and so all right, so the price is 279, and so if I buy, let's say, 280 puts and I buy 280 calls, okay, so and if the market shoots up straight to 300, what's happened to the 280 puts? They are pretty much worthless now,
Decrease in value.
because I have the right. What's the point of selling at 280? What's the point of owning the right to sell at 280 when the market is at 300, right? So the puts have lost value. So the point is that there is some benefit. So Lakshay will lose marks. We'll deduct the marks later on. Okay. So just make a note of his name. Okay. So clearly the point I'm getting at is that once you've formed a view on the eyeball, your next step, whether to buy calls or puts, there is some value addition possible. If you can call the underlying market correctly, then you could decide, in this case, let's say my view is bullish and it turns out to be actually correct. Then if I buy only calls, then I'll make more money than buying the calls and puts, because I'm not losing money on the puts. Is this clear? Okay. So therefore, yes. What happened? Okay. So buy sell options, that decision problem is solved by looking at the eyeball, forming a view on the eyeball. Okay. And then the question is, the next decision problem is call or put. Okay, is this clear? This is formed. This decision problem is solved by taking a view on the. All this is written in your notes in detail in English. Okay, so proper English sentences. So I'm not writing all that stuff here. I just want to put in all the problems in one view. Okay, quickly, and summarize them and give you the structure from head to toe in one sitting, so that you're clear about this. So once you understand this, then you should never forget it in your life. You should just logically be able to go stepwise and create the structure. Okay. Okay. So call put. Yes.
Buy and sell decision problem should also be dependent on underlying asset instead of implied volatility.
No, I didn't get the first part of your question.
Sir, buy and sell decision should also be based on underlying asset rather than the implied volatility.
No, that's what you have to understand. No, because we are. What was the instrument? Okay, instrument we have not written as a decision problem because we are already in the trading options box. We have decided to trade options. So therefore the instrument is already chosen. We are not trading swaps or futures or forwards, right? So that's why I didn't write instrument as a decision problem. Okay, when you write the generic problems on a blank slate, then you put that instrument also as a decision problem because you need to decide whether to trade spot or forwards or futures or options or swaps. Okay, here that decision problem doesn't exist because you're already in the option trading frame box. Is this clear? Now the decision, you will see why. The decision to buy or to sell options is based purely on the view on eyeball. Okay, because we have a separate decision on the question of whether to buy or sell, whatever you decided here. Let's say I've decided, I'm just making an assumption that on this decision problem, I have solved it by deciding to buy. Okay, so therefore I come to the next step, which is to buy calls or to buy puts. Now this decision problem is solved by taking a view on the underlying. Just like the previous one is solved by taking a view on the eyeball, here again I have to go and take a view on the underlying. Okay?
But it is not necessary that the index should be directly correlated to the underlying asset. So
Which index are you talking about?
Sir, VIX, volatility index, to be directly correlated to the underlying asset.
Yeah, that's okay. That's no. You're saying what he's saying is that the eyeball index of the underlying. Okay, eyeball index of options on the underlying here, which is the VIX, and the underlying we are going to take it as the SPY. Okay, so the VIX is not going to be correlated to the SPY. There is some correlation, but we are not going to rely on that. Okay, we're not going to take it as a kind of a law of physics that will always hold. But generally, we will say that we don't necessarily expect some correlation. Okay, what you should know also as a matter of context, this is also in your notes. Okay, as a general principle, broadly speaking, what we expect is when the stock market declines. Okay, when the stock market declines, what do we expect in terms of the movement of the eyeball? It is generally expected to go up. Okay, if we look at 6-month charts and see, you may be able to see that this relationship if we look at 6-month charts. This is a broad, see this massive drop you had in December. When is this December? When is this? This is what date is this? I can't read the date. That is, I think, 30th November, right? What is it? Okay, 3rd of December. This is the American style dating system. So this is 3rd of December. So, and then from 3rd of December to 24th of December, there's a big drop in the stock market. And so let's look at the movement from yeah, 3rd of December, can you see? Eyeball, 3rd of December, from there to 24th of December. This is, I think they have used weekly charts actually. Otherwise, why are we getting such... Okay. And this one, yeah, you're right. This one is daily, and let's make this 1 day. Okay, and let's go to 6 months. All right. Now you can see, yeah, 12/3. You remember the SPY chart? From 3rd of December to 24th December, there's a massive drop. You saw there was tremendous panic all over the world. Okay, because people were saying that the trade talks will not work out and things like that. There's going to be a trade war. So there's a massive drop in the equity index. Okay, and there is what is happening to the eyeball. From 3rd of December, here's 3rd of December to 24th of December. What happened to the eyeball? It shot up. Okay, so there is, again, I want you to be very careful. Don't take this as a law of physics. But in general, we expect this kind of relationship in equity markets. Okay, that when the equity market declines, the eyeball will rise. Okay, the theory behind this is that, again, this is all written in your notes. The theory behind this is that because equity market investors are generally long, okay, so when the market starts to decline, they rush to buy put option protection. Okay, they rush to buy put option protection, and so that drives up the price of put option, and by put call parity, call option price will also have to rise. Okay, so the eyeball has to rise. Okay, so this is the theory behind this. So, but again, as I said, you have to be careful that don't like fall in love with this relationship. Okay, that this relationship is always there. I did this wonderful correlation, and therefore I'm going to bet my whole fortune on this relationship. These relationships are not 100% reliable. Okay, there is a broad tendency. Okay, so yeah, this is on further dilation of your point, observation about the correlation between the VIX and between the eyeball index and the underlying prices. Okay, especially in equity markets, you see this situation. So now we are coming back to this decision problem, which is, yeah. So what we are saying is whether to buy or calls or whether to buy puts, that has to be decided by taking a view on the underlying asset. Is this clear? Okay. So now what I do is, obviously I form this view. This has already been explained to you in your earlier video, that I'm going to form a view on this S&P 500 on the SPY, and let's say my view is that this is going to keep on rising. Okay, let's take a 1 year view. It's going to keep on rising, and this is the all-time high, and it's going to quickly keep on rising and just very quickly clear the all-time highs. Okay, so in that case, what should I buy, calls or puts?
Calls.
I should buy calls. Okay, in earlier step I decided to buy options because the eyeball view is bullish. Now the underlying view is also bullish, so therefore I'll buy calls. Okay, so this brings you to this framework. Okay, which yes, yeah.
So buying a call is
Why don't you use the mic? We have the mic. Pass him the mic. Let's try and use it. Yes. So this is the framework that we are looking at, which we have already sort of just discussed stepwise. Now, when I take this here, the underlying asset, this particular thing will, to get it all in one view. Okay, it's not working out in one view. Okay. Okay.
So column ये कुछ होता है B वाला कुछ होता है.
Okay, now you have it in one view. Okay, so this is just a matrix which helps you to decide. Obviously, it's not very pretty, but this is meant to be that this part of the matrix is on the underlying asset. You are bullish on the underlying asset or bearish on the underlying asset, and this part of the matrix is on the eyeball. You are bullish on the eyeball or the bearish on the eyeball. Okay, so this is the matrix. Obviously, could be done much better visually, but now you understand this framework. Please make sure that everybody understands this framework. Yes, Cheta, are you following? This is just a recap of what we have already decided. Okay, and it's to remember the framework. To put it into this kind of framework just maybe makes it a little easier to remember or whatever it is. But you can also remember it logically. This is clear. So you have this kind of a combination. So I'm going to move on from here. Everyone is clear about this? Yes, Mittal, are you following? Okay. Yes. Yeah. Your question. Sorry. What was the question?
Sir, the start sold by that question is sold by this start.
The answer is, you got the answer?
Yes, sir.
Okay.
But I have another.
Sorry?
I have
Another question.
Another question. Go ahead. Go ahead.
So can you open that chart S&P 500? So that we can see that the market is bullish. So then we can buy the
You can't. From here, it doesn't follow. I just said that I'm going to take a bullish view just for the heck of it. Just for the purpose of crystallizing a decision. You can also look at this and take a bearish view.
Yes, sir.
Okay. So let's be clear about that. Okay. I just took a view because we need to take a decision. Okay. So I forced a view. Yeah.
So if my view is that market is bullish,
Yeah.
then I can buy a call option or I can sell a put option.
Yes. So that's why here, if you see, what do we see in your framework? Okay. Now, why will you not sell a put option in this case? Look at the combination of views. Why have I locked you into? This is something which you have to be clear about, which is not intuitively obvious. What Sahil is saying is obvious, quite obvious, that if you were only looking at this chart, okay, if you are only doing your option trading based on the views on the underlying asset, okay, then what Sahil is saying is true. Okay, of course there are some other nuances to that because the risk profile of those two positions is not the same. Buying a call option and selling a put option, which one is more risky?
So selling a put option.
Selling a put option, because you have to understand this. These are called unlimited risk options. Okay, unlimited risk positions. Okay, that is, in a selling a put option, you can keep on losing unlimited amounts of money. If you buy a call option, if you buy any option, okay, in long option, essentially short option positions are unlimited risk positions, and any long option position is a limited risk position. Okay,
Yes.
that doesn't mean that you can't make money by selling options, or that you'll always make money by buying options, but you have to be aware that these are unlimited risk positions. Okay, any short option position. Okay, so your answer is correct. If we sort of forget about the risk, if we forget about the risk asymmetry, what Sahil is saying is that if my view on the underlying asset is bullish, I can either buy a call or I can sell a put. Okay, that statement is valid if we can forget about the asymmetric risk profiles. That short option positions have dramatically asymmetric risk profiles compared to long option positions. Okay, if we can forget about that, then a statement is okay. But then the other thing that we have to also forget about to make your statement okay is that we don't have anything called eyeball, or we don't have a view of the eyeball. Okay, the moment you bring in, are you following the logic here? Okay. Okay, so if we didn't have anything to do with eyeball, or then there was no concept of eyeball, then his view would be okay. But now we have something called eyeball. So now we have already, therefore we have identified an additional decision problem is the view of whether to buy or sell options. Okay, so therefore we have also formed a view on eyeball. So if in this case my view on eyeball is bullish, so therefore what he's saying is that I could either buy call. When he's saying that, he's only looking at this part of the matrix. He's saying if my underlying asset view is bullish, I can either buy call or sell put. Okay, that is true if you don't have a clear view on the eyeball, or the eyeball view doesn't matter. But if you have a further refined view on the eyeball, that if your view on the eyeball is bullish, why would you sell puts? Because if you're selling puts, means you are expecting the option prices to go down. Okay, it can go down in two ways. All this is all there in your notes. It can go down in two ways. Either if you sell a put, let's go back here. If you sell a put here, the put price, okay, can go down. You're selling a put means you expect put prices to go down. It can go down in two ways due to two factors. Okay, broadly, there are other factors also, but broadly it can either go down because the stock market shoots up. You sell a put here and the market shoots up, so the value of the put declines. You sell an at the money put, which is say 280, and after that the market shoots up. So because of that, the put will lose value. That's one way. The other way the put can lose value is if the eyeball keeps declining. If there is a sharp drop in eyeball, then even without any change in the underlying asset price, your put price will fall. Okay, we can check it here. Okay, if we look at this is also very big. Yeah, if you look at this now, let's look at the put option prices. When the underlying price is at 100. Okay, and now we are going to show it, and let's assume that these are market prices. So these are actually the eyeballs. Okay, this ball input is the eyeball because it gives you a fair value equal to the market price. Remember this definition of eyeball. Make sure you understand what eyeball is. Okay, make sure you go through these because these are all complex concepts you're learning for the first time. So unless you revise it multiple times and understand the concept, you will not get it. Okay, so in this case, if you just drop the eyeball figures, okay, see what happens to put option price 4.4. Okay, let's drop the eyeball to maybe 15 and see what happens. I don't know if you can see the figures. What happens? 2.49. Okay, so the put prices drop. Nothing has happened to the underlying asset price. You notice that? I have not changed any underlying asset price. Okay, but just because the eyeball has dropped, the put prices have dropped. Okay, so essentially if the eyeball index drops, okay, eyeball levels drop, then also your put can lose value. Okay, just like your call can lose value. So there are two ways you can, two broad ways. There are other inputs also that are involved which can also have an impact, but these are the two broad inputs into, the two major drivers of option prices: movements in the underlying asset and movements in eyeball. Okay, so therefore also be clear that you could both of these need not go the same way. Okay, so what I'm trying to say is, let's understand this also. Is everyone clear about this? That the two biggest drivers of option prices are eyeball and
movement of underlying.
underlying asset movements. Okay, movements in eyeball and underlying asset movements. Okay, the two biggest drivers. Now, obviously, there, as Sahil was, Goel was hinting at earlier, that these need not be well perfectly correlated. So one could go in your favor, one could go against you. Okay, so what might happen is after you have bought, suppose here you buy call options, and after that the underlying asset moves up a little bit. Okay, so that is working to increase the value of your call, but there may be a dramatic collapse in eyeball. Remember, you bought call options, so you went long call. Okay, if you go back to this framework, this is where you were. Okay, buy call. You were bullish on eyeball and bullish on the underlying asset. Now this view turns out to be correct. Okay, but this view turns out to be wrong. So whatever you make on this account might, or because of this, might actually be more than offset by what you lose because of this. Is everyone clear about this? Okay, just basic logic, because you have two major drivers. Okay, so both can go in your favor, both can go against you. One can go in your favor, one is going against you magnitude wise, one can offset the other. So all kinds of things can happen. Okay, so you should be aware of these things. Okay, so are we all clear till now?
Yes.
Okay, so let's go back to our DPs. Asset class market, call, put, underlying. Anything else we have to decide? Yes? Expiry date. Okay, so when you look at this option, now we can go to our option trader. Okay, now you can see we have in this particular, because I've chosen the wrong contract, maybe I should just get
So the whole thing is not here. Can you please explain it again?
sorry, come again.
All decision problem is not here. Can you explain it again?
Which one?
So buy or sell.
1 minute. Let me just launch a new. So you have to choose light sweet crude oil. We are not doing this. Okay, this is what Rahul got confused about. Okay, because when I do the recording maybe outside US stock market hours. So I'm using tickers which are going to be live at this time. What happened to this? Maybe I didn't. Okay, let me just do it on this one. Yeah, let me just do it. BB will have trading tools. Let's open option trader on the SPY. This may still be okay. So obviously the next decision problem is your job is not over yet, and this is an incremental decision problem for option trading. You remember when we did the generic decision problems for managing an investment fund? Okay, that was a traditional investment fund essentially. So we didn't have to worry about options. We just said, okay, buy or sell the underlying asset, and we stopped at that point. Okay, so implicitly we were trading, let's say, spot or something like that. Okay, so now we have options. So there's additional decision problems in option trading that we have to decide which expiry are we interested in. Okay, because the prices are going to be different, the sensitivities are different. Okay, so we have to worry about which expiry we are interested in. So if you load the option trader, you will find that there are multiple expiries which are going to appear over here. Okay, let it load. So that's another decision problem. Let's write it down while it's loading. So this is the expiry. That is, what is the tenor of options that you want to trade? Okay, what is the tenor of the option? We are just going to call it expiry. Okay, so here we have a decision based on theta versus vega. Broadly we are saying. Again, this is also mentioned in your notes. There's a chart as well. Okay, so the rule in expiry is, I'm just giving you some broad thumb rules. Okay, once you get confident, you can always break the rules and form your own customized view. But I'm giving you some kind of a structure with which you can operate as a beginner. Okay, which follows some basic principles. Okay, so as far as expiry is concerned, remember that when you come to this decision problem, you have already solved the earlier problems.
Yes.
Okay, so you already have a view on whether you are, this buy should not be here, this should be here maybe. Okay, what happened? just put it as buy. So I've already decided to buy based on buy options based on this, and I've already decided to buy calls, okay, based on this, okay. So at the earlier decision, at earlier stages, my decisions have been buy, and here call, I've chosen calls over puts. So I've got a buy call decision here. So now I have an expiry decision to make. So the general rule here is that when you are buying options, you should push yourself out to longer dates, okay. When you're buying options, you should push yourself out to longer dates. I'll give you the rule first, and then we'll talk about the logic behind it. What happened? Why is this taking so long to load? Maybe there's a net connection problem or something. Okay, let's try something else. Let's go for a slightly. I think the PC is becoming unresponsive because my memory is chock-a-block. Okay, so we'll have to just forget about that for a while, but we can see it in other areas as well that we have. So the decision problem is with respect to expiry. Yeah, it's not responding. Okay, so the decision problem with respect to expiry, what we do is when you're buying, all this is in your notes, okay? When you're buying, we can go down to the notes maybe. Oh, now I've accidentally opened Opera as well. Okay, options, sensitivities, all this is written in your, all these things we have already discussed, the matrix we have already discussed. Okay, we have added the expiry date and then we would come to another decision. I want to just show you the chart, okay? Yeah. So here, what I'm telling you in terms of is visually a little bit clearer. So the broad thumb rule is that when I'm buying, I want to be buying longer dated options. Okay, you can see the, everything has come, but we can see it here. If we look at SPY options here, okay, so where do we see that there are multiple expirations possible? Okay, we can go to a straddle view. A straddle is a type of strategies, but straddle view essentially means that they show you the thing. Instead of showing all the calls first and then the puts first, they show you the calls and puts side by side according to the strike. Okay, so where do you see this? These are the SPY options. Okay, and you can see here how many maturities exist. Can you see that? This is the expiry. These are all these alternatives are available with respect to expiry if you want to trade SPY options. So you have a decision to take which expiry are you going to be trading in. All these expiries exist. That's your decision problem that we are contemplating now. And what we are saying is because you come to this decision problem having already solved the earlier problem, so you're already in the buy, call, sell, put, whatever box. So in this case, since I'm buying calls, the rule is that
Longer period.
yeah. So when I'm buying options, whether calls or puts, I want to go for longer dated options, and when I'm selling options, I want to go for shorter dated options. Okay. The reason this is based on, as I said here, this is based on what is called the theta versus vega view. Okay. I mean not the theta versus vega view, but the two sensitivities. Okay. Theta versus vega. Okay. So the rule, I'm not writing it here, it will take up too much space, but you know the rule. So if you're selling, go for shorter dated options. If you're buying, go for longer dated options. Okay, why is that?
Logic.
Yeah, the logic, I'll give you the logic now. So you remember these sensitivities here? Can you guys read the stuff here? Yes. At the back, Dipanshu? Can you read this? Theta, vega? You can't read it. But I think anyway, if I make it bigger, it will go out of the view. That's another problem. Now so we have to just keep it here. Okay. So you remember that we discussed these sensitivities. So theta is what? What does theta measure? Sensitivity to passage of time. Okay. So theta is negative for both any long option position. Theta will be negative. Any short option position, theta will be positive. Okay. So you can see that theta has a certain magnitude also. It has a sign here. Okay, these are obviously given for long option positions, implicitly for long positions. So theta has a sign, but it also has a magnitude. Okay, so what you will find that theta is very high. If I notice that, let's look at the call option theta as an example. Let's look at the call option theta. Remember this minus 0. I don't know if you can read, but minus 0.024, right? Minus 0.024. So remember this. Now what I'm going to do is I'm going to drastically, this is a 90-day option right now. Okay, I'm going to drastically reduce the days to expiration. Okay, I'm going to make it a very short dated option. Nothing else is changing. Okay, so minus 0.024, and this I'm going to make it like 3 days, let's say, just to make it extreme. Okay, now what has happened here? Minus 0.097. Has the theta gone up? Yes.
On down.
Sorry, come again?
You have to go behind and include.
Okay, fine. But why don't the placement people come here? They are giving you a call.
49 is 1020.
No, but they should call you, no? Shouldn't they call you? No. Let's call somebody. Why don't you call Faraz? I'll just talk to him. Actually, this should not be the way to do it. When you guys have to go for an interview, somebody from placement should come and just drag you guys out. I mean, not drag you out, but because what happens here is that I don't know who's supposed to go for the interview. Gawa, just call Faraz. I'll talk to him. Just call Faraz on your phone. Okay, guys, be quiet. Is this point clear? The theta is higher?
Lower, sir.
Magnitude of theta is higher. Absolute value. I should have clarified. Okay. Now earlier it was losing value at the rate of 0.02 per day. Now it's going to lose value at the rate of 0.09 per day. Okay. So is this clear? Okay. So what is the principle we are trying to establish here? We are trying to establish this principle that shorter dated options have much higher theta. Okay. Which is what is the same thing that has been shown in your notes. When you go to your notes, this chart. The shorter dated, the theta, this is plotting the theta as a function of time to expiration. Okay. This is the magnitude of theta. It is always negative. Okay. And it is plotting it it's just a simple XY graph. Okay. So it is plotting this, and this is because theta is always negative. It is for a long option position. Okay. So theta will have, when it comes to shorter dated options, the theta becomes dramatically negative, in the sense the magnitude of theta is very high. Absolute value of theta becomes very high. So therefore, because remember, my decision is, what was my decision? My decision was to buy call. Okay, so now I want to be buying longer dated options, because what will happen to remember when you have a call option, what happened? You didn't get him. He's not picking up.
So profit will be consumed by time.
Sorry? Or if you have Mugdha's number, you call Mugdha. Okay, so they should have actually organized it in this manner, because it should not be done like this through the... okay, guys, please pay attention. Don't use this as an excuse to lose your focus. Is this clear what we have established? These are all complicated points. You need to be careful about what we are discussing.
Profit will be consumed by time.
Sorry?
Profit will be consumed by time.
Yeah, so if you have, these are for long option positions. The theta, negative theta, is for long option positions. Is he there?
Yes.
Hello, Faraz. Faraz. Hi. I'm in a class. Do you need some? Okay, so is this clear? Now we have established that when you have a long option position, if it's a short dated option, it will have very high theta. Okay, but if it's a longer dated option, the theta is much more manageable. Okay, remember, for a long option position, theta is always working against you. You need to understand these concepts. so well that eventually you'll end up memorizing them without actually memorizing them in the first place. Okay, that long option positions have negative theta. Okay, and if you have and if it's a shorter dated option, it will have very high negative theta. That means the loss of value per day will be very high. That's why when you buy options, when you're going to be buying options, calls or puts, your strategy is to focus on longer expiry dates, where the theta damage is not going to be that much. Is this clear?
Yes.
This is clear to everyone?
The
Okay.
negative sign denotes.
Another thing, all this is in the notes.
What does the negative signs denote?
What is the negative?
Negative signs denote.
Negative sign denotes, okay, let's be clear about that. So negative sign denotes, so these sensitivities are for long option positions, okay? Now, what is the negative sign? It shows that if you have a long option position, okay, with these parameters, okay, underlying is here, exercise price is here, then once you buy this option, if nothing else moves, ceteris paribus, every day this option is going to lose this much value. That means this 0.559 call option, okay? If you reduce you can do this experiment and see, okay? It will not be exactly the same, but it will be rounded off in one minute. When you ask the question, let me answer. Don't be like a journalist. Wait 1 minute. Just wait and listen to my answer, okay? What does this mean? The question is valid because we need to be clear about these things. What does this mean? That means that if you go long this option with these parameters, okay, and if nothing else happens, ceteris paribus, nothing else happens, but 1 day passes, okay, so it goes from, say, whatever, 3 days to 2 days. The 1 day has passed, okay. In 1 day, the estimate of the option valuation model is that this call option value 0.559 will reduce by 0.097. The minus 0.097 means that this particular premium will reduce by minus 0.097 if you change the days to expiration from 3 to 2. This is clear? That's what it means, okay? So bottom line, what we have learned as a principle is that you should recap the earlier learning, that all long option positions, okay, call or put, have negative theta, okay? Whether you're long calls or long puts, the theta will be working against you, okay, and you will lose time. Lakshay, can you come and sit here next to Mittal, and I'll deduct one more set of points from your group. You guys are constantly talking, you and Prachi. Come here, come and sit next to Lakshay, come and sit next to Mittal. Come and sit next to Mittal, so we can split up your group. Come here, quickly. Okay, so what have we learned? We've learned that long option positions have negative theta. Okay, so whenever you go long options, you have to be worried about how much are you losing per day due to the theta. Okay. Then another thing we have learned is that if you can play around with the expiration date, the longer dated options will have much less theta than the shorter dated options. Is this clear? Another thing we have learned, you can visually remember. Pictures are easier to remember than numbers or words. You remember this picture, that theta is a function of time to expiration. Shorter dated options have very high theta. Longer dated options have much less theta, okay? So therefore, when you are buying options, your strategy is to buy options. That is what you have decided based on the other earlier decision problems. Here in this example, my decision was to buy a call. So therefore, when it comes to the decision as to the expiry date, I will choose a longer dated option. Now, what is longer dated? Should it be 6 months? Should it be 9 months, 7 months, 8 months? That is not exact, okay? Obviously, the further out you go, the less theta that you'll have, but then there's a point at which your extra premium versus the saving of theta, you have to balance that trade-off. So here the answer is, again, as you notice, is not a very scientific answer. It is only saying, okay, push yourself to longer dated options, but how long, that is something you have to use your judgment on, okay? This is clear? Everyone is clear about this? How do you solve the decision problem as to the expiry date, okay? Now, there is another reason for this, okay? This is also written in your notes. So maybe we can even look at the notes.
So what if we are selling an option and expiration date is near?
I'm coming to that. First, let's get clear about the longer dated options, okay? Another thing is, the longer dated, another reason for this decision, okay? The decision is clearly that if you are going to be buying options, you make sure you buy longer dated options, not very short dated options, like not below 15 days or so. 15 days, below 15 days becomes really short dated, okay? So, but further out you go, the better it is in general, but then you have to see what is the incremental benefit. Okay. The other reason is that longer dated options also have higher vega. What is vega? Vega is the sensitivity to what? Yes, Priya? What? You have a big grin on your face. I thought because you like options with high vega. That's okay. So another principle, another reason for the decision. Okay, what is the decision we took? We said that we want to buy, let's stick with the picture, we want to be buying longer dated options and we want to be selling shorter dated options. Okay, so another reason for the same decision rule. This is a decision rule that we have. Okay, a decision rule is when we are buying options, we will buy longer dated options. When we are selling options, we'll be selling shorter dated options. Okay, another reason for the decision rule is that longer dated options also have higher vega. Okay, remember what is higher vega? Vega is the sensitivity to what? Vol. Okay, so vega is the sensitivity. What the vega is measuring is the sensitivity of this. Vega is measuring the sensitivity of the option premium, these two things, to changes in the vol input. Okay, the changes in the vol input, changes in I vol. We'll call it changes in I vol because these are going to be market prices. Okay, so essentially that's what vega is measuring. So then remember, why are we saying, when let's take one part of the decision, okay, the one part of the decision rule, the buying options part. We are saying that you want to be buying longer dated options, one because they have lesser theta, and the second reason we are giving is because they have higher vega. Okay, so remember, why am I buying options? What is my view on I vol if I'm buying options?
Bullish.
My view on I vol is bullish. Remember this matrix. Okay, maybe you should not even remember the matrix, you should remember it more intuitively. But if you see that I'm buying options, either buying calls or buying puts, that means my I vol view is bullish. Okay, so therefore either way, here I want to be, therefore if in a longer dated option, what will happen is because I'm buying options, I'm buying longer dated options have higher vega. So therefore if my view turns out to be correct, I will get more bang for my buck. Are you following? Because if my view turns out to be correct, I was bullish on I vol. Okay, so like I look at this chart and I'm bullish on I vol. Okay, and actually my view turns out to be correct, I vol shoots up to 25. Okay, in that case, if I had bought longer dated options, because the sensitivity, the vega is much higher for longer dated options, so the options which I bought, the price will change much more in response to the change in vol. Are you following the logic?
Yes.
Is everyone clear? Sensitivity is more. Okay, so therefore the price will move much more, so I can get more bang for my buck. Okay, so that's essentially it gives you a chance to benefit more from the I vol view. Okay, so therefore, and then the reverse is true. Shorter dated options have lower vega. Okay, so therefore what you want to be doing is, as a general rule, so this part is, the second part is not so logical in terms of the selling decision. The decision to sell shorter dated options is mainly driven by the higher theta of shorter dated options. Remember, now if you're selling options, you want the theta to be very high, because you don't want, when you sell an option, all you want is that there should be no movement. Really what you want is, when you're selling options, as far as the I vol view is concerned, there should not be any movement and I vol should start to drop, and then every day you will pick up all the theta belongs to you. You sell something for $20, the next day the price becomes $19, the next day the price becomes $18, and so every day the price keeps dropping by the amount of the theta. So you want to be collecting the theta as a seller of options. Okay, so it's clear. So therefore you want to sell shorter dated options. Okay, and they also have lower vega, so in case there is any movement in the I vol, the damage is also less. Okay, but mainly this is driven by the theta aspect of it. Okay, so is everyone clear about the expiry decision? Okay, the expiry decision problem, you need to choose the expiry. Okay, as we showed you here, so many expiries to choose from. Okay, which one do you choose? Generally go longer dated if you're buying, go shorter dated if you're selling. Yeah.
Please explain it in the case of selling ones.
Okay, so selling, what we are saying is, see, if you are selling options, okay, if you look at this, remember this, we said the signs of the vega, theta, everything is for long option positions. Okay, So if you're selling, this will become positive. The theta will be in your favor. The theta is negative for long option positions. If you buy a call or you buy a put, every day the theta will work against you. We've written this earlier in the note somewhere, that long option positions have negative theta and short option positions have positive theta, which means they benefit from the theta. So short option position obviously will be the opposite. In a long option position, if you go long options and every day the theta works against you, that means that in a short option position, that should be the reverse. The theta should work in your favor. Is this clear? Okay. So therefore, the main driver of this decision to sell shorter dated options, when you are selling options to be concentrated on the shorter dates, okay, the main driver of the decision is that shorter dated options have high theta. Okay, they also have less vega than longer dated options. Okay, so if you have any dramatic movement in eyeball, the corresponding change in the option price will also be limited. Okay, so if the eyeball goes against you, then the damage will be less. Okay, but the more important reason to be selling shorter dated options is because they have high theta. Okay, so the theta is high, and a short option position you will be benefiting from the theta. It is positive theta. Is this clear? Everyone's clear? Okay. So we solved one more decision problem. So you can see that there is a structured approach to solving the decision. It's not just something randomly you decide buy here, sell there. There is a structured logic as to how you come to the decision. Is this clear so far? Okay. Any more decision problem left? In option trading, any more decision problem?
Sir, at the money.
Yes, at the money what? We are going to have to give up on this. I might as well shut this thing down because it's obviously not able to function properly.
Eyeball chart should be a cross-sectional data.
Eyeball chart will be not necessarily, depends on how you are plotting the eyeball. There are two types of. So Sahil is saying that the eyeball chart should be a cross-sectional data chart. Okay. Now my answer to that question is, or that statement is, not necessarily, depending on what you're charting. Okay. But let's clear up this concept. It's a good thing that he's asked this question. Let's clear up this concept. This is an eyeball chart. The VIX. The VIX is, we also have an India VIX. You should be aware of this. India VIX is plotting the eyeball for NSE options. Okay, so this is a VIX chart. Okay, this is for the S&P 500 index. Okay, now this chart, when you see this, does this look like a cross-sectional data chart or a time series chart? Time series chart. Okay, so that's why my answer to Sahil's question is not necessarily. Depends on what you're plotting. So if you are plotting eyeball in this manner, okay, this is actually roughly for about 30 to 40 day options that they take, okay, tenor of options. So in this case, the eyeball, you have to see what is being plotted. Here it's a time series data chart. But if you look at your notes, I have, not in this note. Remember in the earlier note, okay, I had a chart. Let's say we can just plot it here quickly, okay. If I do it this way, okay, so if I do 1 month, 2 month, 3 month, 6 month. Okay, so now 1 minute, be careful. This is already there in your earlier module notes, in the forms functions notes. Okay, suppose I plot this as 6%, then 12%, okay, 19%, and say let's say 50. Let's make it a little complicated term structure. Okay, now this is my plot. Now what are these? Let's say this is the chart that is there in your Tesla options. Okay, this is the chart that is there in your notes in the earlier module. Okay, so I looked at Tesla options, both calls and puts, and I find that this is Tesla options eyeball. Okay, so this is Tesla options eyeball. Okay, if I look at 1 month options, I find that the eyeball for 1 month Tesla options is 6%. For 3 months, it's 19%. Okay. All right, okay. Is everyone clear about this? Are you following?
Yes.
What did I do? I looked at options on the common stock of Tesla, both calls and puts, and I computed a IVOL index, okay, which we can actually look at. This is the chart ticker that is already there and you're seeing. Let's do it here. Although Tesla is not one of your options, not one of your tickers, let's figure out how you're going to get, let's look at this. Okay, this is also going to give you only one option. So if I take Tesla and I do go, I will get a response. Okay, can you see it's giving me a response, okay, in terms of eyeball charts, and this is again the time series data chart, so it's not a good example. This is the time series data chart, but the point is I can actually get I can look at 1 month Tesla options, because remember options you have multiple expiries.
Yeah.
So I look at 1 month Tesla options, I find the eyeball is 6%, okay, which means that I need to enter 6% in the OVM to get fair value equal to the market price. Okay, be clear about eyeball as well. So 1 month options is this, 12 months is 2 months is this, 6 months 6 months. Now if I plot this, what kind of chart will it be? Time series or cross sectional?
Cross section.
Not everybody is confident. Cross sectional data chart. Now it is a cross sectional data chart because these are at a point of time and for different maturities. One particular variable at least being plotted, multiple maturities at the same point of time. Is this clear? So this is a term structure. So this we call, remember the general expression is term structure. Okay, and so we look at so we call this a term structure of eyeballs for Tesla options. Okay, all right. Now quickly to get you through the let me just put some other. Okay, so expiry. Any other decision problem? Quickly, I need to make sure I finish this in this session itself. Any other decision problem? What are these things? You've decided, let's say you have decided that your expiry is going to be May 17th. I chose the May 17th expiration for buying options on whatever this is, SPY. Okay, I want to be buying calls on SPY and expiration is May 17th. So I've decided this also. Any other decision I have to take? Is there any other decision I have to take? Strike price. As Goel says, strike price. Obviously, because there are so many strikes, I can't be buying all the strikes. Nobody would buy all the strikes. I have to decide which strike. Okay. So this is where you get to the point where if you remember the view that because I had to close the TWS. Okay. So you have an additional decision problem which is strike. Okay. Strike is the other decision problem. Okay. So strike is again decided based on eyeball and etc. I'm writing etc. because there are other considerations, but here's an important thing to learn. Okay, see, normally notice that when you look at this here you don't have the eyeball information. Okay, here you don't have the eyeball information, and here you find, I'm just going to make it, I don't know why this is not, the fonts are not becoming bigger. Okay, here you find this is what is the price? 279. So here you find more activity. Okay, now these are the premia. Okay, I think they put the prices on the first. Yeah, last price. How is it time? It's not time. No, 1 minute. 1 minute. I have to make sure I finish this logic. Okay, the last thing, 1 minute. Please notice. Okay, there is still time. Wait 1 sec. I'm going to finish this. Okay, please pay attention, guys. Okay, 279. Here is the price. When you launch your option trader. When you mouse over the bid and offer, you will see there are some percentage figures.
Yes.
You see that some percentage figures being shown, those are the eyeballs. Okay, that you don't get in a normal display. So here when you look at this, okay, suppose 279 is the price. Okay, when you look at this, the calls, let's say we look at 279, let's look at 280. Okay, the call is worth 576. Okay, this call is worth, I'm already deciding to buy calls. Okay, so this call is worth 576. This call, a 284 call, is worth 375. Okay, and this is worth 576. The 280 call. The 284 call is worth 375. Now this obviously, if you look at the premium itself, this is cheaper.
Yes, sir. Yes.
Okay, but the learning here is that you do not decide which option is cheaper and which is more expensive by looking at the absolute premium. You decide that by looking at the eyeball. Okay, when you look at the eyeballs in the TWS, you will find that they don't all have the same strike. Okay, there's something called a volatility smile. Sometimes you'll find that the at the money options have lower eyeball, out of the money options have higher eyeball. Okay, so what am I doing here? My decision is to buy a call. I'm a buyer of options, so I want to buy cheap options or more expensive options. Cheap options. Okay, how do I decide an option when an option is cheap? Not by looking at the absolute premium, but or this 375 is cheaper. Wow, this is great. 375 is cheaper than 576. I have to mouse over this in TWS and I have to look at the eyeball. The ones which have lower eyeball are cheaper options than the ones which have higher eyeball. This is the learning that you have here in this incremental learning, that whether or not an option is cheap or expensive, you decide that by looking at the eyeball, not at the absolute premium. Is this clear?
Yes.
So there are some other considerations also based on your view of the market. Okay, so okay, so is this learning clear now? Just 1 minute, I'll just make sure that everybody's clear so that you can actually move on. The strike is based on which strike to buy. I will buy, when I'm buying, I will buy strikes with lower eyeballs. When I'm selling, I'll sell strikes with higher eyeballs. But there are some other, this is not so clear cut, but this is one of the important considerations. The main learning is option cheap or expensive, not based on the premium, but based on the eyeball. Is this clear?
Yes, sir.
Okay, so now you have enough learning to go ahead and trade.
Yes, sir.
Okay, everybody has to send me the trading actual project account name and account number.
Already sent.
You have sent, nobody else has sent. Clear? Okay, you can go now.